Now friends, let me explain to you the provisions relating to the business trust or real estate investment trusts. Okay, see here in this particular provision, first of all there is a special scheme in the sense that to promote the investments into certain sectors in India, government has this kind of a scheme and the package. Okay, first of all, see these provisions of 1023 FC and FCA. Okay, these two sections are the hardcore exemption sections with respect to business trust or real estate investment trust, REITs. Okay, now REITs or the business trust, whatever you want to say, okay, they will make investments into the specified entity. Okay, just understand the hardcore basic transaction. REITs or business trust will make the investments into specified entities. Okay, they will make the investments. So what will India get? India will get the flow of investment. That's the first part of it. Okay, then these specified entities will give the return. Okay, return in form of interest, dividend, etc. Okay, so they will give return to the trust or this business trust. Okay, this return in the hands of the business trust, subject to conditions, will be given a exemption. Is that okay? Now these REITs or this business trust which will bring in the investments, they are basically of the investors. Okay, so investors invested into REITs and the REIT invested into specified entities. Okay, specified entities gave return to the REITs, which is exempt. Okay, and the REITs in turn will give the return on investment back to the investors. Okay, so what the REITs have got exempt, now when REITs will give it to the investor, will become taxable. It will become taxable. Okay, that's the whole idea. But that taxability of the investors, that we will discuss afterwards. Okay, so first of all, let us discuss only those transactions which is in relation to the REITs and the specified institutions. Okay, first this is one part of the discussion, and this the investor taxation will be the second part of the discussion. Okay, that way it is logically the reciprocal of each other, but we'll just discuss because some variations are there, so we'll divide our discussion accordingly. Okay, now first of all, we are only discussing the REITs. Okay, okay, now see, income of a business trust. When business trust has made investment into a special purpose vehicle. What is this special purpose vehicle? Special purpose vehicle is already defined here, that the special purpose vehicle is an Indian company in which business trust is holding a controlling interest and any specific percentage shareholding as may be required as per the regulations. Okay, so basically here you will have to have the controlling interest, okay, in the special purpose vehicle will mean an Indian company in which the trust is having a controlling interest. Okay, so the special purpose vehicle will make the payment to the business trust. Okay, and if this payment is in nature of interest or dividend, this will be exempt. Okay, so when I will say 1023 FC, okay, so 1023 FC means interest or dividend income from special purpose vehicle in the hands of the business trust. Is that very much clear? And the special purpose vehicle is basically the Indian company in which they have a controlling interest, and that Indian company which has basically got the inflows of the investments is going to make the return. Is that very much clear? That is a special purpose vehicle. Now 1023 FCA. This 1023 FCA is the income of a business trust. Okay, this business trust as a real estate investment trust called as even REITs by way of renting, leasing or letting out. Basically, it is a rental income or the lease income of the real estate. Okay, so this is going to give boost to the real estate sector. So any income in the hands of the business trust which is in nature of rental income on account of the real estate owned directly by such business trust. Okay, so here the business trust has to own that particular real estate assets directly, okay, not through the special purpose vehicle. That if it is holding a direct real estate from which you have got this particular rental incomes in the hands of the business trust, it will be eligible for the purpose of exemption. Now, when I say 1023 FCA, okay, this particular, what does it mean? It means the rental income out of the real estate assets, okay, and this income will be eligible for the purpose of exemption in the hands of the business trust. Okay, now this business trust which has got all these incomes which are exempt, okay, ideally there should be no TDS on that. It's a very natural thing, because if the income is already exempt, then what is the sense in deducting the tax at source? Okay, so all these specified income types, this type and this rental income types, okay, these rental income types, on this there is no TDS. Okay, so there is a TDS benefit which has already been specifically provided in the respective provisions. I think the relevant extracts I have already given it to you. 194 for the dividend, 194I for the rent, and 193 for the interest. Okay, so these specified incomes in the hands of the business trust or the real estate investment trust, okay, will be eligible for the purpose of no TDS, because they are logically the exempt ones. Okay, so that's a pretty good simple part of this particular taxation. Okay, now come to 115UA provision first of all. 115UA provision. Okay, now see, 115UA provisions makes it very clear that normally all these incomes are already exempts. Okay, so that is your interest, dividend, and rental income. These three income types, subject to all the basic condition, it is already given a exemption. Okay, these incomes, the business trust will ultimately forward it to the, this income will ultimately forward it to the unit holder. Okay, so when it will be forwarded to the unit holder, it will be regarded as of the same nature. Okay, so supposing if the business trust has got a interest income which is forwarded to a unit holder, the unit holder will also treat it in a similar way like an interest. The treatment of the law will be of a same nature. Okay, that is the first clarification. That is basically from the investor point of view. One second, erase. Okay, that is the first point. Then business trust is normally already given an exemption. Okay, so if you have any incomes other than the exempt incomes, it will of course be taxable. So business trust has already got exempt incomes, specified incomes are exempt, but supposing if you have any other income which are not exempt, that will be eligible for the purpose of taxation. That's a very natural thing. Okay, so subclause 2 makes it very clear. Subject to 11A and 112, that is basically the incomes covered by special rate. So if subject to these particular provisions, if you have any other income, it will be chargeable at maximum marginal rate of taxes. So if you are covered by these types incomes, 111A or 112 type incomes, then you will be having that particular rate of tax. Otherwise, by default, it is going to be maximum marginal rate of tax. Okay, and ideally these real estate trusts should not have only the other incomes, because your main activity is to get this exemption. So that exempt income you are having, that should be enough. But if you have made other investments other than the exempt ones, and if you are getting a return on that also, then that is of course taxable, and that will be subjected to the maximum marginal rates of taxes. Okay, now that's a very simple thing and very understandable thing. Okay, now think about the unit holder. Okay, now the unit holder, it's a very natural thing that if the business trust is already paying tax on that, then unit holder will not be paying a tax on that. And if the business trust is taking it as exempt, the unit holder will become taxable. See like a partnership firm basically. If the partnership firm is paying tax, then the share of profit is exempt in the hands of the partner. As simple as that. Okay. So that is covered by this subclause 3. Okay. It says that where any income is distributed, received by a unit holder. So distributed, which is received by the unit holder, which is in nature of FC or FCA. This is basically the exempt incomes. So if exempt incomes are already distributed, it shall be deemed to be the income of such unit holder and it shall be chargeable to tax. Very, very natural thing. So if the business trust has got an exempt income, then the unit holder, the same to same income will become taxable, because in someone's hands the law has to tax it. So only thing that it is taxable in the hands of the unit holder. Now here there is one small little complications, but that complication I will tell you afterwards, because one point is very, very typical here, that is, that combined interpretation of this particular provision, but that I will take it up afterwards now. See, this is also 1023 FD is also for the unit holder, and this provision when you read with 115 UA provisions, this is a little bit tricky in interpretation, but that I will do it afterwards. Right now I am keeping the things very simple for you. Okay, so that is already done. Now further, this clause 3A has been introduced into the recent past. Okay, understand this way. Imagine a situation that a business trust and the unit holder. Okay, business trust is exempt, so same income will become taxable in the hands of the unit holder. If the business trust is taxable, okay, business trust is taxable, say for example, okay, in that case, that particular income will be exempt in the hands of the unit holder. Okay. Now, earlier when I said exempt, it was covered by 1023 FC or FCA. Okay. What if, because see, if this particular provision, here it is FC exemption and FC exemption. Okay. What if it would have got some other exempt incomes? Other exempt incomes under section 10, example, or it can be exempt anywhere, okay, subject to the provisions. Other exempt income, supposing if under section 10, so business trust will take that particular exemption, okay, will that be taxable in the hands of the unit holder? See, this is already exempt under section 10. Example I am saying, example, this is only an example. Will that become taxable? Have you understood that? Okay, so the law says nowadays that this will become taxable in the hands of the unit holder. But it is subjected to the condition, and that will be taxable as hands of the unit holder as income from other sources. Okay. So see, subject where the provisions of subclause will not apply. Okay. Where the income is referred to under section 56 subclause 2 of this particular clause, this is basically IFOS, which is received by the unit holder from a business trust. Okay, so if you go and read this particular section, section 56 to subclause 12, okay, it says that where any specified sum which is received by unit holder from a business trust, so unit holder is getting this particular money from a business trust, okay, specified sum, then it will be income under the head other sources. And what is the specified sum that you are getting? Okay, specified sum is any sum which is distributed by the business trust, which is not in the nature of this particular section, because if it is these two 1023 FC or FCA, then this is already covered by 115 UA, the provisions. So it is not in the nature of this particular clause, okay, and not chargeable to tax under UA2. That means it is not taxed also under UA2. UA2 is basically those income by default which is subject to MMR. So by default, every income of UA2 is MMR unless it was covered by some specific provisions. So if it is not charged under this particular clause and it is other than these incomes, okay, in that particular case, this will be covered by subject matter of taxation under the head other sources in the hands of the unit holder. Okay, and this taxation is of course based on the formula A minus B minus C. So it is A is basically your income, Okay, that is your specified sum. Okay, amount at which unit was issued. Okay, that is basically the cost price of the unit, and the C is charged to tax under these provisions under any of the earlier years. So basically your whatever amount you received minus the cost, that means the surplus, the profits. The profit if you have already got, that will be taxable under the head other sources in the hands of the unit holder. Is that very much clear? And here whatever is taxed under subclause 12, keep that in mind. See, the law makes it very clear that subclause 1 shall not be applicable. In other words, the nature of income will not be the same here. The nature of income will be taken as IFOS only. Is that very much clear? So, if it is 1023 FC or FCA, the nature of income will be the same. That means if it was an interest income, if it was supposing the rental income, in the hands of the unit holder also it will be treated similar to a rental income only. The nature of income will remain the same if it is 23 FC or FCA income. But other ones, now it will be regarded as income from other sources only with respect to the unit holders. Okay, so this is hardcore basics of these particular provisions. Now, there is one more promotion which is given by the government here. Okay, now here it says that if specified persons, okay, make the investments, okay, and any income which is in nature of dividend, interest or any sum referred to under this particular clause. Okay, so where the specified persons make the investments into the business trust subject to all these dates conditions. Okay, so specified person, when they make investments into this particular business trust, and of course the specified incomes will be eligible for the purpose of exemption. So this one more section is introduced by the government to give a boost or to promote more investments into the business trust by the specified persons. And these specified persons are really a good list of people here. See the definition of specified persons. Okay, the persons from Abu Dhabi, specific investments, sovereign wealth fund. Okay, the all conditional things. Okay, pension funds. So these type funds, when they make investments, and ideally they will make huge investments into India, okay, because they have big money. So when these people will make investments into India and when they get the specified incomes, will again be eligible for the purpose of very good exemption, will be getting a very good exemption for this specified type of the transactions. Is again a promotion and a fillip which is given by the government.